here is this voicemail.
Hey Brad, I talked to somebody at Robinhood and they said the smart money, typically in reference to selling puts, will always, the expiration will always be 45 days out and then sell within the last week or two. What's your recommendation on, as far as less risk? Would you trade in regards to selling puts? Would you do weeklies, bi-weeklies, monthlies, or yearlies? I'm just curious as far as the less risk. I know there's always risk in options, but the least risk that you can take and why. Also, if you can do maybe an example of selling puts and what to look for in the Greeks as far as selling puts, what are the key Greeks to pay attention to? Thank you. Keep up the great work.
All right, so let's touch upon a couple things here. Number one, awesome you got to speak to Robinhood. That's something you would not hear. I'm surprised they even gave you that advice, so good on them for that. I will have to say that I agree. I'm trying to hook up my whiteboard. I should have done it sooner, but I can explain it without the whiteboard. And then I can definitely show you an example. We'll dive into my portfolio here, and I'll show you because I'm going to be writing some puts this week, so I'll tell you exactly the things I'm going to be thinking about. So the reason that we use this 45-day marker is, and here's kind of what I was going to draw, so I'll kind of visually tell you what I'm talking about. In terms of theta, so we know that the options value, and this is a little bit boring to people, but it's important. So the value of an option is built of two things. Intrinsic value, which is solely dictated by the difference between the share price and the strike price. So the greater that difference, the greater the value of that option, and it has to be that. Okay, so you can't have an intrinsic value that's smaller than the difference between the share price and the strike price. So that's kind of the one that's out of our control, or the one so much that we can't really play because we have no idea what's going to happen to the strike price. We have no idea if it's going to go up, going to go down. We could kind of trend it out and see if it's going to work, but we don't really know. The other one is the one that we can kind of gamify a little bit, and that's the other side, extrinsic value, which is theta, one of the Greeks, which is really the thing that affects the buyer. As a seller of an option, we love theta. As a buyer of an option, we hate theta because theta is the pay to play. It's the cost that the buyer loses in the value as we approach expiration. The other one is volatility, but volatility is not really going to come into play here. So why this 45-day mark? Why as sellers do we like 45 days and as buyers we're trying to go leaps? We're trying to go way out in expiration. If we look at the trend of how much theta is eating away at the value of that option, it stays pretty flat over time until about 45 days out. So if I buy a leaps option, I buy a call that's way out there, I know that for the majority of that time, theta is really not going to affect me. It's going to be so small that theta is going to just drop off by the littlest amount. But then when I get to the 45-day mark, it starts to do this and exponentially change. So as the seller, if we were to write puts further than 45 days out, we don't have the true advantage of theta just yet. Okay. Now, when we do weeklies, there's essentially 3 weeks or so that theta's already been accelerating the loss of the value of that option. Okay. Really, it depends on your personal preference. There's a number of reasons why you might want to do weeklies and you might want to do monthlies. I'll give you one right off the top of my head, and I've discussed this before a little bit. But in the summer, or I'm going on vacation or something like that, when we're trading options, we really need to be there to monitor those options at least once a day. Really, if we really want to be successful. Okay? So, if I'm going to be on vacation, I can't check it this week. I might do a monthly, okay? Because that gives me a little bit of leeway. I don't really need to check it. Maybe I could check it every 3 days. That's not that big of a deal. The other thing is sometimes options only have monthlies, so you can't do the weekly. The third option, which is kind of where I'm at with puts, is puts for me is all about an annual return on investment. And whatever form you want to use, I just did a video about that a little bit, about how I find the annual return on investment, but even the short-term return on investment. So if you take the collateral needed for a cash secure put, right, the strike price times 100, and you see how much premium you get, you could find that return immediately. So if I really am looking for a set return in my cash secure puts, the expiration doesn't really matter, right? I can go 6 months out. If 6 months out is going to get me a 12% return, and that's a 24% return on my investment, I don't really give a shit about theta, to be honest with you. So that might be an indication or a time where I might go 6 months out because I'm just trying to get a guaranteed fix, or maybe it's just above the fair value of the stock that I really want. And I'm saying if it gets down to that value anytime in the next 6 months, this is just the strategy that's been the best for me recently, okay? These are going to be stocks that I want a return on investment but don't necessarily need to own. An example of this in my portfolio is CCL, Carnival Cruise Line. I'm not like itching to get into Carnival, but I really feel like I can get them at a good price. So that's an example that I put out way in advance. My expiration, I'll bring it up real quick so we can see. So if we look at my expiration for Carnival Cruise Line, that's 3/18. So if I open this up real quick, I got $119, and that was, I think, about 6 months out for $2,000. I don't know, where's my calculator? So essentially, I said to myself, okay, I could put $2,000 out and I can get 119 back. So 119 divided by 2,000, that's the collateral, times 100. That gives me a 5.95 return on that investment. So 6%, a 12% return automatically if the price drops down to $20. And it's currently $18.20. It's currently $18.20. So right now, I'm on the hook to get CCL at $20. If it keeps dropping, okay, $20 was what I chose. But regardless of getting assigned those shares in 6 months, I made 12% annual return on my money for this stock. And if I do get assigned, I'm getting assigned at a price that's favorable to me that I really want to get it at. That's not every single stock. Another one like that for me is Smith & Wesson. I put that out a long way in expiration as well. So this one I had to put up $17.50 and I got $85. So to me the math was 85. I put up $17.50 times 100. That's 4.85, and this was a little less than 6 months, but I'll still multiply it by 2. That's a 10% return on Smith & Wesson if it gets down to $17.50. Now, if you're like, that's not a great return, bro. I'm trying to YOLO AMC. Okay, good for you. But I look and I'm like, okay, they went up 50% this year. That's good. If I can throw another 12% on top of that, I'm really good. So those are two examples of where I'm just strictly looking at a return on investment as far as my math is concerned. I was assigned on Camping World and I was assigned on HPQ this week. Okay, so now here's how that's going to work. So with HPQ, I was assigned and I was credited. So when you're assigned on a call, here's it right here. I got assigned at $31.99.97, essentially $3,200. Okay. So I'm going to tell you right now, the next time that is red, so these had a green day on Friday, I only write puts on a red day because the value is up. As soon as that value is up, I'm coming in here. I'm going to trade options. I'm probably going to go to the next expiration. I'm going to go down to my assignment price. Right now, that's currently $13. But this is a green day and it's off market, so these are not accurate. But as soon as they're a red day, it's going to come back. And if I get assigned, I wash out that covered call. My basis on the call stays the same because of the wash rule. I'm good to go. I go back to my basis, which I think was like 3,100 and change. I'd have to check my spreadsheet. Okay, so that's a particular case where I'm just going to go 7 days because I want those shares back. And I'll get them back at the exact same price. Like the 7 to the 45-day rule, that would be like if I was trying to figure out what value I wanted. I'd go 45 days to 6 months if I knew the price I wanted. But when I'm assigned on a call, the price that I want has already been told to me because I want to write at the exact same strike I got assigned at. So let's make that happen in 7 days, right? There's also going to be circumstances, and this is where your gut feeling, this is where education comes in. If this was it's right now like $2 below my strike, okay? If it took a dump like what's going on with my Peloton put, if it just dove down and I can't write at that at that strike price because I'm going to get no premiums whatsoever, that's when I might push out expiration or try and roll at a loss on that put. But it really it feels it out. You feel it out. Okay. They were right in telling you 45 days. You don't really want to go more than that unless you're just seeking a general return. And a weekly just means that most of that drop off from theta, that's really, really taken its hold. The second part of your question was about the Greeks that I look at. For example, the CCL. I'll tell you this. I'm not too concerned with the Greeks when I'm doing the wheel. When I do leaps, it's much more important to me. That is definitely the truth, okay? But here, we can see that I'm at a 0.55 with this call, and this is once again, this is the CCL. And it's pretty much right at the money, and that makes sense. A delta of 0.5 means it could go either way. But if you're starting the wheel or you're new to puts and you're new to writing calls, here's where you can use delta to your advantage, or at least use delta to help you out. Delta, regardless of its technical definition, okay, we use it more for a general rule of thumb. And it's the approximate likelihood or percentage that the buyer is going to succeed with this contract. That this will finish in the money before expiration. So right now, the buyer of this option has a 55% chance of success. So where does that leave me? I'm the underdog at 45 right now. Okay. If you're just starting the wheel or just starting writing covered calls or puts, and you don't really want to mess with assignment, and you're like not at the point where you're like, I'm not ready to be assigned, you might look for a small delta because that's going to be a low percentage for the buyer, high percentage for you. So for example, a delta of say 0.2, that means that the buyer has a 20% chance of success. That means you, the seller, have an 80% chance. So if you're looking to like stay a little bit conservative while you're learning that, this might be a great opportunity for you to use delta as just a general rule of thumb. Okay, it's not the actual definition, right? It's not actually 80%. It's right there. Okay, that would be the only time I would use it. But for me with the wheel, I'm dictated by the strike generally and the return on my investment, whether it's the return over 6 months, a year, whatever. The only time I'm ever going to look at the Greeks is when I'm looking at delta. Like, for example, outside the wheel on the poor man's covered call, because I need to protect my buy option, my leaps, I'm only going to write calls against those leaps with a very, very small delta because I do not want them assigned at all. But for the wheel, I go right at the money. As long as my strike is above my cost basis, the average price for shares I paid, I don't care about assignment. And the same on the put side. I'm going to make this for $32 because that's what I was assigned at. I do not care what the delta was. I do not care about any other Greeks. I know as the seller, there's not that many Greeks I need to worry about because the other one that's really relevant and every day for like us beginners and us people that aren't dabbling too deep, all I need to know is as the buyer, theta hurts me, and as a seller, theta helps me. All right, buddy. Hope that answers your question. If you have any follow-ups, please let me know.